Welcome everyone to our pre-retirement planning webinar. My name is Michael Sauer. I'm a certified financial planner here at Source Wealth. In today's session, it's going to be all about pre-retirement planning, and we will have a Q&A session at the end of the appointment as well. So as we're going through, if you have any questions that do arise, please pop them in the Q&A section or the chat box. All right, so starting off today's appointments, firstly, this is a general advice presentation. None of the information is tailored to any unique individual circumstances. To provide personalised advice, that's what we do through a statement of advice by working with clients and through a range of appointments. So everything that we talk about today is general in nature. In terms of today's agenda, we're going to go through why retirement planning is important and what can go wrong. We're going to talk about how much you need to retire and when you can retire. Then we're going to talk about what proactive steps you can take for your retirement in terms of superannuation considerations and strategies, government age pension considerations and strategies, and how to structure your assets for retirement. And finally, investment considerations in retirement. And then finally, we'll go through a Q&A session at the end. So firstly, why is retirement planning important? Well, we all want to afford the retirement that we have dreamed of and have worked hard for. We want to make sure that we are financially comfortable through retirement and avoid having to rely solely on the age pension. Now, in a few slides, I'll explain that the age pension alone is often insufficient to meet a comfortable standard of living in retirement. So therefore, you need to have other assets you can rely on well beyond the government age pension. Next, we want to make sure that we're retiring at the right time. If you're retiring too early, you may not have enough money to fund your later years in retirement. But if you're retiring too late, then you may regret not retiring sooner. We want to make sure that we're taking proactive steps to improve our retirement rather than just accepting the default position. So age pension starts at age 67. So most people will be able to have some sort of retirement from age 67, but the quality of the retirement really can be different for everyone based on how well they have prepared for it. Now, here are some common traps and red flags that I see with people in the lead up to their retirement. Now, the first one is inaction. So time is your best friend when it comes to retirement planning. And one example of that is that the earlier that you start investing, the earlier you can benefit from compounding returns over time. The same applies to different strategies that we might implement as well. So for instance, superannuation contribution strategies, it's often much better to start contributing extra into super because there are different yearly contribution caps. So we want to make sure we're not just leaving it all to the last minute. The next red flag that we often see is DIYing, so doing it yourself and making significant financial mistakes. So this could be a failed investment type. It could be potentially lending, a friend or family money that you never get back, or a failed business, or it could be a health issue that affects your ability to work. All these types of things can often cost thousands, which really means years of your retirement. You may have to work longer to be able to make back those losses. Next, being too ambitious. So your retirement plan should have inbuilt safety buffers for unforeseen circumstances. So for instance, there may be some years where you have health costs or an inability to work for those years, or there may be years where there's bad investment years, so on the stock market. So we want to make sure that in your retirement plan, you've got a buffer for unforeseen circumstances. And finally, making excuses. So really your retirement will be as good as how you plan for it. So let's talk about what changes with retirement. So firstly, your income is going to primarily switch from being from employment to being a mix of different types of income streams. So for most people, you'll have superannuation that you can access after age 60. Government age pension kicks off at age 67 for people who are eligible from an income and asset test perspective. And then many people also have their own personal investments and savings that they can use. Your expenses are also likely to change. There'll be some expenses that are related to your work that will drop off, but you may have new expenses that begin. So things like extra travel, if that's a goal, or extra spend on different hobbies that you now have the time to do more of. So the next one there is time. So the best retirements that I see are ones where they are gradual and phased. And when I say that, often clients will go from working, say, 5 days a week down to 4 for a year or two. And with that extra day of time that they've got, they'll then start doing extra hobbies or things that are fulfilling for them. So it could be golf, it could be looking after grandkids, volunteering, learning a new hobby, whatever it might be. And you can gradually do that and keep dropping the amount of days that you work. And that's a really good way to transition into retirement rather than just fully retiring and going from working, say, 40 hours a week down to nothing. And that can often be an abrupt change for people. And then the next one, health, particularly as you get into your later years, 80s and onwards, people start slowing down and you might have extra health costs that you need to consider, but then also later, things like aged care or in-home care as well, and the different costs involved with that. So let's look at a retirement benchmark. So this is produced by the Australian Superannuation Fund Association, and it shows for a comfortable retirement for a couple, you need $73,000 per year. And some of the things that are listed in a comfortable retirement are shown on this screen. But you'll note one thing that stands out to me is that only includes one international flight every 7 years. So if you're the sort of couple who want to travel overseas every year, then you'll need a lot more than that. It might be, adding an extra 10, 20 or 30,000. The same with other hobbies. This is, whilst it's a comfortable standard of living, it still is fairly a basic standard of living. So it really depends on the individual in terms of how much you want to spend each year in retirement. We know that 73,000 is sort of where we want to at least get to per year, but it could be as high as 150, 200, 250, depending on how ambitious your goals are. And so therefore we need to work out how much you need to get your retirement savings to meet that objective. So everyone's favorite question is, how much do I need to retire, or when can I retire? And there's a range of factors that underpin this question. So we can't just give a default answer. Sometimes you'll see in the newspapers, there'll be some sort of headline saying, you need $1 million in super to retire, or whatever it may be. But there's no way of knowing what that actual amount is until you know the individual circumstances of your retirement. So it's things like, what are your annual expenses per year? What are your goals? So will you have additional travel costs? Becoming more common is also people wanting to support their children or grandchildren, particularly with gifts or loans to get into the property market. And that obviously has an effect on your potential retirement savings as well. Do you want to stay in your home long term, or will you actually free up some proceeds by downsizing? Next, when will you retire, and therefore what is the time frame? So if you retire at 50 versus 75, obviously if you retire at 50, you're going to need a lot more in retirement savings built up because you're covering an extra 25 years of retirement. So it really depends, when is your ideal retirement age, and can you actually support it based on how much wealth you've built up? Next, what is your investment mix supporting your retirement? So how well are your investments performing? Are they all in, say, just cash or term deposits? Do you know how well your superannuation fund's performing? Do you know what your asset allocation is, which is the mix between what types of investments you have within your super? So things like shares, it could be property, it could be cash, fixed interest products, etc. Next, are your investments in the right tax structure? And we'll go through a scenario later that really talks to the benefits of getting your investments in the right tax structures and how much you can actually save there. And then finally, can you manage drawdown risk? So drawdown risk is the risk that you incur a significant loss in the first year that you retire, and you're drawing down those proceeds at the same time to support your living expenses. So let's say the share market goes down 30% in 1 year, so it's a really bad year for the share market. Then if you don't have enough cash in reserve to pay those income streams that you need for that year to live off, then essentially you'd have to sell down some of those investments at that reduced rate. Now, as we know with share markets, they typically always bounce back. So it's just about making sure that you've got the right mix of assets to be able to withstand any negative investment downturn as well in the short and medium term. Now, next, I'm going to play a video which shows our retirement modeling software. And it's for a fictitious client, but it really helps highlight several things. So it shows you how much wealth you potentially need to get to for retirement. And it also shows the different levers that you can pull to potentially change your retirement outcomes. This is Mark and Claire Johnson. They're 45 years old and they've just paid off their mortgage. They want to know when they can retire and how much they'll need to retire, whilst also meeting their other life goals, such as purchasing their holiday house for $1 million at age 56. They want to send their child to private school, costing $15,000 a year from age 45 to 51. And they want to increase their travel budget in retirement by an extra $20,000 per year. In this graph, we're showing the net worth of the clients, excluding their family home. You can see the orange bars denote their superannuation, which then converts to an income stream from retirement. And it also shows their other personal investments in the dark blue. So that's things like their savings or their personal shares. And we can see clearly from this graph that they can easily meet all of their life goals and still have plenty of money in later retirement. So they've got $3.3 million of investable assets and superannuation, even at age 87. Now let's change some of the scenarios for them. So Mark and Claire might want to reduce their investment risk down from a high growth portfolio to, say, a balanced profile, which is fairly common in retirement, to reduce some of that volatility and the ups and downs each year. And we can see then the effect that that has on their net worth over time. As you can see, their goals are still all very achievable. It's just that their investable assets have dropped somewhat significantly from the previous scenario. Now, let's say they decide they want to retire a little bit earlier than age 65. And let's have a look and see if they can afford to both do it at age 63. So having a lower investment risk tolerance. And they can still do it. It does mean that by age 87 in this scenario, they've got $218,000 in present value in today's dollars. So it is still possible, but it is getting a little bit tighter. Well, let's say they were happy to spend $10,000 a year less then. And these are all the different types of trade-off discussions that we have with clients in terms of how they want their retirement to look. And this modeling provides clients with real clarity and control over their financial future, and also helps us formulate what our strategy decisions will be. So as you can see, that's a really powerful tool that we help show clients, and we do it on an individual client basis, and it helps answer those questions. How much do I need to retire, and when can I retire? So what steps can we take to positively impact our retirement planning? Here are some of the main ones. So firstly, there's strategies for maximizing superannuation and minimizing tax. Remember, superannuation is a really tax effective structure. So earnings are only taxed at 15% in accumulation phase. And once we're fully retired and it's in an account-based pension, the tax rate's actually 0%. So it's a really fundamental building block of your retirement planning. Secondly, strategies for maximizing government age pension. Detailed financial modeling to forecast how much you can afford to spend each year in retirement. Next, a review of your investment asset allocations to ensure the mix is suitable for the retirement phase. which often requires a more conservative approach to investing. So we've got a whole slide which talks about the risk and reward trade-offs with different types of investments and shows how often retirees will start having a greater proportion in those lower risk investments like fixed interest products and cash. Next, assistance with managing wealth transfers if you would like to provide early inheritance or gifts to children and grandchildren. As I mentioned before, this is becoming more common, particularly for parents and grandparents wanting to help their kids or grandchildren get into the property market. And for clients with significant wealth, it's also often around about trying to determine how we minimize some of the capital gains tax implications of passing on funds. Lastly, protecting your retirement savings against longevity risk, which is simply the risk of outliving your savings. So we want to make sure that the retirement savings that you do build up cover you to well beyond life expectancy. So superannuation, as I mentioned, is an extremely tax-effective investment structure with only one main downside, and that's that you need to wait until at least age 60 to access it. It should be the cornerstone of any good retirement. Now, ask yourself, is your super fund performing? Or do you even know if it is performing relative to a similar benchmark? Next, is your super fund cost effective and or value for money? So it doesn't necessarily have to be the cheapest super fund. For instance, some clients might have a self-managed super fund, which is by no means a cheap way to do it, but it could provide value for money by allowing the different types of investments that those clients want. Next, is your asset allocation right for your investment timeframe, which we'll talk to later on? And are you making additional contributions where possible? In terms of superannuation contributions, there are many types of contributions that you can make. We'll talk about the pre-tax concessional contributions and the post-tax non-concessional contributions in a little bit more detail. But there's also downsizer contributions, which allows you to put money from the sale of your house into superannuation. There's also spouse contributions, which allows you to reduce your income tax by contributing into a spouse with a low income. And if you're a small business owner, there's also various exemptions, which allows you to put money from the sale of your business into superannuation in a tax-effective manner, which doesn't trigger capital gains tax. Now, pre-tax concessional contributions, these are contributions that are good when you are looking to either lower your income tax, so often for people who may be high income earners, or if you've got a significant capital gain, so you may have sold a property or an investment and it's triggered capital gains tax. For superannuation balances below 500,000, you may be able to use carry forward allowances. So what that allows is it allows you to go back the previous 5 financial years and use any unused concessional contribution cap space. You may know that the maximum that you can put in at the moment in any given year is $30,000. So let's say you only put in 15,000 for this year, you would have 15,000 allowable in your carry forward allowances to use in the next year. Now I've got a little note there saying it can be unwise to reduce your taxable income below $45,000 because at that point between 18,200 and 45,000, the tax rate's only 18%. Now, the tax rate when you contribute into superannuation in a pre-tax concessional contribution is 15%. So the differential is so small at 3% that it's not really worth it. And in fact, it would be better off in most cases to save that carry forward allowance to the next years where you can get a bigger percentage reduction. Next, post-tax non-concessional contributions. So these are often contributions you make from, say, your bank account, which in contrast to concessional contributions, they're often ones like salary sacrifice that you may have elected with your employer to take out as part of your payslip. So post-tax non-concessional contributions are good when you don't need to lower your income tax. So you may not have a high income tax due to your salary as they enter the fund tax-free, so they don't have that 15% tax when received. And they also add to the tax-free component of your superannuation balance, which is important when you eventually transfer your super to, say, your beneficiaries or adult children, if there's money left over at the end. Now, I want to take you through a carry forward contributions example. Now, this strategy can be particularly useful for those who haven't contributed for a number of years. So think about sole traders who aren't obliged to pay themselves super, or skilled migrants coming into the country who begin earning a good salary but haven't contributed in the past, and they want to make sure that they're catching up on their retirement savings, and those returning from an extended paternity leave. So let's go through the column without concessional contributions first. In this case, I've assumed this client's earning $250,000. They're making no concessional contributions, so their taxable income is $250,000. On $250,000, you would pay $87,950 in tax, which is quite significant. Now, let's say this client had funds in savings, so they could make a considerable $130,000 concessional contribution into superannuation, and that would drop their taxable income to $120,000. Then you can see the really significant effect that has on the income tax payable for that year. So it reduces by nearly $60,000 a year. Now, there is some tax that you do pay on superannuation contributions, so nearly $20,000. But the net effect when considering both those taxes is that there's a tax saving of $40,000 a year almost. And the added benefit here is we've got more money in that low tax rate environment of superannuation. So it's a really effective strategy. Now, even if you have contributed in the last few years, so you don't have the full $130,000 of concessional contribution cap space, you may have a portion. So this strategy is still very effective for most people, remembering that you wouldn't necessarily want to go below $45,000 for tax purposes. But yeah, it can be really effective for most people. So let's talk about some of the different superannuation account types. So for most of us, we have superannuation accumulation accounts. These accounts are ones that receive contributions from your employer. The earnings are taxed at 15%, and contributions that are concessional are also taxed at 15% on the way in. These accumulation accounts are typically then converted to a transition to retirement or account-based pension from age 60. However, the important thing to note is most super funds don't proactively contact clients to actually get them to switch over. So let's say you retire and you don't transition your accumulation account to one of those pension accounts, then your earnings are still going to be getting taxed at 15%, even if you're well into retirement phase. So you do need to elect to transfer them over. Now, a transition to retirement pension is available from age 60, and it can pay you a tax-free income stream, which is really good, but only up to 10% of the balance. So that's one of the eligibility criteria, is that it can't pay more than 10% of the balance each year. The earnings are still taxed at 15%, so there's no tax benefit on the earnings relative to an accumulation account. And these accounts automatically convert to an account-based pension at age 65. So account-based pensions have some added benefits over transition to retirement benefits. So firstly, all the earnings are now tax-free. The withdrawals are still tax-free, the same as the TTR pension, but there's also now no restriction on the amount that you can withdraw. So you can withdraw 100% of the balance if you wanted to, but it's very rarely recommended because you want to keep as much in that tax-effective environment of a pension account as possible. Because it's so tax effective, there is a maximum of $1.9 million that you can have in these account-based pensions. And any overflow you can have in an accumulation account, and it's likely going to be up to that $3 million cap, which is currently going through Parliament. And then after that, there's an additional proposed 15% tax on earnings above $3 million. But not sure if that's going to get in because it is quite unpopular. And it's also got some issues around the treatment of unrealized capital gains. So that's a wait and see on that one. Lastly, defined benefits So these are quite rare these days. Typically some government departments, so emergency services, police force, things of that nature. Now, defined benefits are usually on a like-for-like basis, a lot better than accumulation accounts. With accumulation accounts, we all bear the risk of the investment markets and the ups and downs that we get each year. Whereas with a defined benefit, the balance is determined by a specific formula. So quite often it's things like average final salary times years of service times a particular multiple. So there's no investment risk that that account has. And the formulas are also quite generous in the relative rate of return. With those defined benefits, you often then do get a choice at retirement, which can be to create a pension account with that defined benefit provider, or it could be to roll it over to another superannuation account, or take a lump sum, or a combination of both. And that's where we often do the numbers behind which is the best investment decision for you. Age pension 101. This is the basics of age pension that you need to know. So age pension is a payment from the government, and eligibility starts from age 67. So you must meet an income, asset, and residency test. So the residency test for anyone who is new to Australia is typically 10 years of living in Australia. So the income test includes something called deeming. So it's not just what the income that you generate from employment is, and it's not even the income that the investments make. Instead, they calculate a deeming rate based on the balance of your investable assets. So it's a slightly different treatment than what the actual dividends and income streams that are produced by those investable assets. A full age pension couple will receive $44,855 currently, and singles $29,754. So if we think back to the slide before, which showed that you need $73,000 to have at least a comfortable retirement, then you can see that living on just the age pension is, in a way, an uncomfortable retirement, and it certainly is. So we want to make sure that we've got superannuation and other investable assets as well as a potential age pension. So as a homeowner couple, you could get a part pension if your assets are below $1,045,000. And that doesn't include your primary residence. So you can actually have a $5 million primary residence, and as long as your assets are below a certain point, you can still get a part or full pension. So in that example, let's say you had $500,000 for you and your spouse, and in superannuation and your primary residence, then you could still get a partial pension. And sometimes it's important to actually get the part pension because the pension discount card is actually worth around about $5,000 a year. So things like council rates, utilities discounts, public transport discounts can be really, really large. So you actually want to get a part pension, not so much for the actual amount you get from the government, but more so for the discount. So often if you're around that 1,045,000, sometimes people do strategies to get just below to get all those discounts. Next, as a homeowner couple, you could get a full pension if your assets are below 470,000. So you've got your house, let's say, paid off. You've got 200,000 each in a superannuation account, $50,000 in cash account. You'd be getting the full age pension there, so of 44,855. Now, if you think that you've still got, $450,000 of investable assets, and that'll be generating you income, so let's say around about 5%, then that could be around about 22,500 a year of income. And if you add that to the 45,000, then you can see we're getting quite close to that $73,000 a year. And you could choose to draw down some of the capital of your super each year to be able to have a slightly more comfortable retirement as well. So as I mentioned before, strategies are often available if you're just below receiving a partial pension. So if your assets are just above the 1,045,000 for a couple, not including the home, sometimes people do things like renovate their house if they need to, because that reduces their their bank balance, but increases the asset value of the house, which isn't included. Sometimes they'll buy things called annuities, which have a partial asset test exemption. It's a type of investment product that pays generally a guaranteed income stream for a certain amount of time. You can buy funeral bonds up to a certain amount, around about $15,000, which aren't accessible. And you can also gift some money to children. Again, there's small caps there. So only $10,000 a year, up to a maximum of $30,000 across 5 years. So that's really only a strategy if you have a goal to gift money to someone. So it doesn't necessarily have to be your children. It's just the most common thing we see. If that's your goal, firstly, and if you're just above that asset test limit. Now, if you're both retired or working rarely, so you're not going above the income test areas, and you have an age gap between you and your partner, you could receive extra Centrelink. So let's say you have one partner who is 67 now and another partner who's 60. Well, a common strategy there is to put more money into the superannuation account of the younger spouse, because superannuation is not accessible as an asset until you reach age 67. So you can see by moving more money from potentially the 67-year-old's pension account or savings or whatever it might be into the superannuation account, then you effectively have less assets and therefore can get a greater rate of age pension. Now, one consideration for that is you will then be paying the 15% tax on earnings on the extra superannuation account, but typically that's a far better outcome than not getting the extra age pension. All right, so we're going to spend a little bit of time now on a case study, and it's talking about the optimal retirement structure. Now, you'll notice in these three scenarios, each client has total assets worth $7.5 million. Now, even if you don't think your assets will get to that level, that's fine. Many of these concepts still remain the same, even if your assets at retirement are, 2 million or 3 million or what have you. What we're really looking at is the differences from a cost, income, and tax perspective, both now and in the future, across these three different scenarios. So scenario one, this is what we'd consider a pretty optimal retirement structure. The clients have a $2 million family home. They've got $3.8 million in their pension account, so $1.9 million each, which is the maximum that they can have in that fully tax-free environment. Then they've got $1.2 million in Australian shares. And the reason why they've got $1.2 million is based on the dividends that these produce. Let's assume at a 5% yield, that would be $60,000 of income. And that's split in half, so $30,000 each if they own the shares jointly. Then that amount of income is actually below the tax-free threshold for seniors, because seniors get this extra uplift called the seniors and pensioners tax offset. So they're actually not paying any personal income tax with that amount of Aussie shares. And as well as that, Australian shares provide something called franked dividend refunds when you're below the tax-free threshold, which actually gives you a refund of the tax that the company has already paid on your behalf. So let's say they're all in, Telstra and BHP shares and things like that. Telstra and BHP already pay company tax for you on your behalf, and then you can actually claim that refund as well. So it's really good. Now, with the last $500,000, that's in superannuation, because we don't want to have any more money in the shares because it could start triggering income tax, and they also can't have any more in their pension account. So really, it's just to show what you do with the overflow, and that would be in superannuation taxed at 15%. Next, we've got a client with just a $7.5 million home. So this is a classic asset-rich, cash-poor scenario. And you may think, $7.5 million home, that's, an insane value, which it definitely is. But you actually commonly see this for clients where they might be in their sort of 80s or 90s, and they've just had a property in a really blue chip area for decades and decades and decades. So it's a really valuable house now, but they've used all their other retirement savings as they've had a long life. Scenario 3, this is a client who owns their own primary residence for $1.5 million, and then they really are property people. So they've got $6 million in a range of different investment properties, all owned in their personal name. So let's consider now the income, tax, and cost perspective of each scenario. Now, scenario 1, this is where you see all the different green. Now, green means good. Firstly, their income now, they've got $5.5 million of their total $7.5 million in investable and income producing assets. And generally you want a high proportion in those investable and income producing assets rather than in your property, because that's what you're going to live on long term. And that could generate, $225,000 per year, at 5% income yield. Next, we want to look at the tax. This is where this strategy really shines. It's an extremely low tax approach. Only the $500,000 in super is likely to pay any tax, and that's at a 15% tax rate, as we know. So again, assuming that makes a 5% yield, then it's only $3,000 per year. The costs are also very low in this situation. So when we compare that in a few slides to property has a lot more ongoing costs, whereas for shares, there's actually basically no ongoing costs. Super and pension fees are really low, particularly as your balances get higher. And then you've just got the normal maintenance with your primary residence costs. Now, in the future, and we'll talk primarily about inheritance in this situation, it's likely that the primary residence would be sold. Superannuation and pension assets would be converted to cash for whoever the beneficiary is. The share income could remain if the beneficiaries want to keep those shares. From a tax perspective in the future, it's also quite a good outcome. Now, when your beneficiaries sell the primary residence, it's unlikely to have any tax when sold in the first 2 years. So it still gets that primary residence capital gains tax exemption. With superannuation and pension accounts, they have both what's called a taxable and tax-free component. And there are a range of strategies from age 60 to 75 where we can actually increase the tax-free component of the superannuation balance and get a good outcome there for beneficiaries. With the taxable component, so it's typically tax-free when given to your spouse, but adult children often pay a 17% tax on the taxable component of the super balance. Now, the capital gains tax on shares can be easily managed when passed on to beneficiaries because shares are quite liquid. And what that means is they can be sold in really small portions. So you could even decide to retain the shares fully, or just gradually your beneficiaries could sell the shares in small parcels so to not trigger too much capital gains tax in one hit, which, as you'll see in a few slides, you can't do that with property. You either have to sell it or retain it. And as we know, the costs with this structure are very low. Now, let's look at the next structure of being asset rich, cash poor. This structure can't work really. And the reason being is there's not enough income. So they've got no investable income, and this client would still get the full age pension. So let's say it's $44,000 as a couple, but the rates on a $7.5 million house are going to be around about $15,000 a year, depending on the council. So that would drop the net amount that person has to live on to $29,000. Now, that's not an amount that anyone could live on. So this strategy doesn't work. Now, it is definitely true that you could sell the house, and that's definitely an option. The problem sometimes can be, as people get older, it becomes more and more difficult to actually leave the house as well. Now, next, with the tax now, there's no tax now, so that's a fine outcome, but we know it just can't work from an income perspective. In the future, the house could be rented out by the beneficiaries. However, it's likely to be sold within the first 2 years, as those beneficiaries are likely going to want the lump sum amount of cash. And, typically houses worth that much don't have a, relatively high percentage income yield. Now, from a tax perspective in the future, it's still going to be fine because primary residences sold within the first 2 years after being received in inheritance are capital gains tax free. But we just know this scenario just can't work from an income perspective. Scenario 3. So this is one where the clients may really like investing in property, which is fine, but they haven't paid much attention to their superannuation. So commonly it could be, say, business owners who were never employees. And the problem with this structure is not so much the properties, because you could have property in a self-managed super fund. It's actually that the properties are all owned personally. So from an income perspective now, there's $6 million in investable assets. So it actually produces quite a high income yield of $240,000 per year. The issue is that it's a very bad tax outcome. So if this generates $240,000 in income, this couple could pay $60,000 a year in tax, which is massive when you compare it to this $3,000 a year in scenario 1. So this could be $1.2 million over 20 years compared to $60,000 in the other example. So it's just such a bad tax outcome by not being planned early enough. It's also a bad cost outcome because properties do have a lot of ongoing costs. So things like rates, land tax, which has obviously gotten bigger recently with some of the changes from the Victorian government, and tenant costs that pop up as well. Now, in terms of the future, these properties could be kept. However, it's likely that beneficiaries would sell them, as all that income being added to the taxable income of beneficiaries who are likely still working if they're adult children would create more tax issues for them. And it's also hard from an estate planning equitability perspective to split properties because they all have different asset values. So if you've got multiple kids, how do you actually structure it in a way that you're fair to each child? That's a really hard part. Whereas with, say, your superannuation balance, you can just split it evenly. Now, we know primary residence is unlikely to have tax when sold in the first 2 years, and the investment properties are illiquid, so they're likely to trigger considerable capital gains tax when they're sold, which is another bad tax outcome in the future. And we know the costs in the future are also considerable with those different property costs. So that just shows you all the income tax and cost differences. Yes, it is quite an extreme scenario given the $7.5 million asset value, but it just shows you how much of a variance in terms of tax and income there actually can be by poor planning. If your position, you might get to say, $3 million asset value, again, a lot of those income and tax and cost effects, the rationale behind them still ring true, and you just need to apply that to your situation. I really want to talk about the risk and reward trade-off with investing, particularly in retirement. And this is a great graph that shows the different rates of return across different asset classes from 1994 to 2024. And we can see if we invested $10,000 in 1994, what would that be equal to amongst each of the different asset classes? Now you can see that 10,000 would have converted to $237,000 in US shares, and that's been generating an average rate of return of 11%. So it's clearly the highest performing asset class. However, if I look at the GFC in 2008, 2009, you can see that the US shares are even below Australian bonds over that 15-year period. So that's why it's important to have diversification, because there's different time periods, as you can see visually, where different asset classes perform well and when they don't. So typically with your superannuation, if you haven't made an election, often your super fund provider will have you in quite a high growth investment style, particularly the younger you are. And so you might have a really high proportion US shares and Australian shares and some listed property funds and things like that, which is really good because you've got a really long investment time frame. So it doesn't really matter having downs in the investment markets, which you can see visually. We had one in the dot-com bust in 2002. Then we had the GFC in 08 and 09. Then we had COVID in 2020 for about 3 months there. That was a really small dip. And then we had a little dip in 22, 23 due to the changing interest rate environments around the world. So having these long-term high growth investments are great when you've got a really long investment time frame. And you also do need a portion of them even in retirement, because you need to outpace the cost of inflation as well. But what quite often happens in retirement is that you'll have a greater proportion of things like Australian bonds and international bonds. And you can see visually that blue line is relatively flat. So it doesn't have the huge ups and downs. And you might have a little bit more allocation in cash as well. So sometimes those clients are prepared to accept a slightly lower average rate of return for the ability to have some more downside protection when investment markets are bad. Because remembering, in these years when you are retired, you are now drawing on those funds. So you don't want to be locking in any capital losses in those really bad years. And often in those bad years, we have a cash bucket in your pension account or outside investments so that you can withstand those time periods without having to sell down investments at a loss. Thank you, Rob. So what is the 3 or 4 bucket strategy in retirement? Well, in terms of, it really depends on what asset allocation you go with. It is important to have a certain amount of cash in retirement. If we look at this chart here, we can see that most market downturns usually only last for 2 or 3 years. So if you had cash in your pension account equal to 2 or 3 years, if you absolutely needed to not sell down any of the other types of investments, that's usually a pretty comfortable an allocation. So 2 or 3 years worth of living expenses, because we also don't want to have too much cash, because as you'll see in this graph, cash historically underperforms over the long term these other investments significantly. So we want to have enough that we're protected against downside risk on share markets, but not too much that the overall performance is affected. So yeah, typically you'd have a set percentage in cash, and then the rest of the investment mix in those other types of investments. And it really depends on your risk tolerance in terms of how much of each of those asset classes you do have. A, on your risk tolerance, but B, also on your investment time frame as well. So I hope that's been really helpful for you all. I've enjoyed talking about retirement planning. It's one of the big areas of work that I do. So with that, have a great night. And yeah, thank you so much for all of your input. And I hope to speak with you all soon.